Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Happy New Year and welcome to our IFRS Insurance webcast. Today, we're going to talk to you about the decisions that the IASB has completed during the first round of IFRS 17 amendments discussion on the 13th of December. At that meeting, only one decision was getting to an amendment of the IFRS 17 requirements, and that is on the balance sheet presentation. The agenda for today's webcast is in three parts. First, I'll give you the highlights, beside what I already said, of the meeting. Then we will do a longer session where I'm going to go through point by point each of the concerns that were discussed and the merit of the decisions that the IASB has reached during the meeting. At the end, I will spend a couple of minutes to discuss what are the next steps at this point for the IASB. So talking about the highlights, they are now kicked off formally, the process that will analyze the 25 concerns that have been identified for potential amendment at the October meeting of the IASB. A previous webcast covered those potential amendments, and we commented already on some of that material. In the meantime, in the November IASB meeting, the IASB already approved an amendment to IFRS 17 and another amendment to IFRS 4. These two amendments dealt with two timeline-related concerns, and the decision was to add an extra 12 months to the effective date of IFRS 17 and to amend IFRS 4, which is the standard that contains the deferral of the IFRS 9 effective date for entities with significant insurance operations, also by an extra 12 months. So now this change will be exposed and subject to comments being favorable, the IASB will then put that into the text of the two standards in the coming months. For this past board meeting session, there was also an educational session that was held on the 11th of December, and it was focused on the insurance concerns, one of which has already been deliberated this past month. The others will be coming in the future. Out of the remaining 23 concerns, 13 have been dealt with on the meeting on the 13th of December, and only one, the one I mentioned earlier on the presentation in the balance sheet, has been approved to be the source of an amendment to IFRS 17. And the amendment is that we are now changing the level of aggregation for balance sheet presentation. We're moving up one notch. So instead of being presenting assets and liabilities by reference to group of contracts, we're moving into a portfolio level of aggregation. The other 12 concerns were all deliberated with very little disagreement as to not being a justifiable source for an IFRS 17 amendment. So we'll go through that one by one during the course of the presentation today. There are 10 remaining concerns that are expected to be covered this month, and in my opinion also next month. So I predict that the IASB will probably spend 2 more months to finish the full round of assessment of the concerns. Interestingly, hopefully for you, is that 5 of these remaining 10 concerns were presented back in October with a preliminary review of the IASB staff to be positively favorable to these concerns to produce a valid amendment to IFRS 17. So although the percentage of concerns that generated an amendment in December was very small, 1 out of 13, we could reasonably expect that half of these 10 concerns coming up in January and February could generate another 5 amendments to IFRS 17. Let's see. But let's focus now on what happened in this December IASB meeting, beginning with the one issue, the one concern that produced an amendment to IFRS 17. So this is the amendment, as I said earlier, on the balance sheet. So let's go back on the source of the concerns to understand what the requirements are and why a number of stakeholders deem them to be worthy of an intervention that has now led to an amendment. The balance sheet under IFRS 17, you probably know it, but let me just remind you, is going to be utterly simplified compared to what you have today. Effectively, you cannot have no more than 4 numbers. The 4 numbers are an asset and or a liability for insurance contracts issued, and an asset and a liability for insurance contracts held. And it's not necessarily the case that you will always have 4 numbers. It may be that you have only an asset for insurance contracts held and only a liability for insurance contracts issued. The calculation of these 4 numbers must be done based on the current text of IFRS 17 using a group of insurance contracts. So that means that you need to look at that unit of account that is bound by the 12 months period, and then within those 12 months it could potentially be subdivided further into a group of profitable contracts with no chance of turning into an onerous contract group in the future, onerous group of contract, and the rest. And that is portfolio by portfolio. So each portfolio will have several sets of group of insurance contracts. And in each of these groups, you will have liability for remaining coverage, which may come from the general measurement model, the variable fee approach, or the simplified premium allocation approach that is focused on making that particular calculation simpler when the coverage period is 12 months or less, or if some eligibility criteria have been met. Together with this liability for remaining coverage, you also have the liability for incurred claims arising from the same group of insurance contracts. So that means that the group of insurance contracts from a balance sheet sign perspective may actually switch from an asset to a liability position over time. Even within the same portfolio, you may therefore have groups which are assets and groups which are liabilities. And that could be done only if you maintain a rigorous analysis that allocates the cash flows received and paid on a group-by-group basis. Stakeholders have raised since February last year at the TRG, the first TRG meeting, the concern that this requirement is highly burdensome and expensive to implement, and recommended that action is taken in terms of amending the requirements. Suggested amendments, which are summarized in the paper of the board meeting last month, include a different level of aggregation and even measuring the PAA liability in a different way. The reason why PAA was picked up is because it's the one that effectively could offer the biggest concern from a preparer's perspective. So the question then is, the IASB staff concluded that these concerns were valid, and so this would be a proposed amendment. And they asked the board whether they would agree to amend 78. And you see there in italics how 78 would be amended with the replacement of the word groups with the word portfolios. If we look at the discussion that followed, the staff obviously begins the session for every paper by articulating further points. In particular, they say that there is merit in providing this relief by requiring entities to present insurance contracts at a higher level of aggregation than group, and also indicated that based on their analysis, IFRS 17 in this way will not unduly disrupt the implementation process, and in fact may reduce significantly the implementation cost because it will simplify the implementation for many entities. Given what I said earlier in the previous page and in these additional points from the IASB staff opening remarks, they explained that created a logical foundation for their recommendation that would allow effectively a much greater level of offsetting of assets and liabilities in the balance sheet of insurance companies. The staff reminded the IASB that the group itself may contain contracts which are assets and contracts which are liabilities. So already the group creates an offset. But what they're going to do now is to move to an even larger level of aggregation, therefore making the offset an even greater extent than before. When the board responded to these arguments, noted that there is clearly a clash with the principles of the conceptual framework, the IS1 presentation of financial statements principles and IS32. Nonetheless, the discussion confirmed that the arguments articulated by the staff in the paper were deemed to be sound, and in particular, the IASB board members were convinced that the benefits of the amendments outweigh the cost. So when they came to a vote, only one board member still held a position that was contrary to the recommendation, and the 13 other members actually voted in favor. So this is now tentatively agreed and effectively logged in the list of the future amendments that will be then published in an exposure draft in the coming months. Now we begin looking at all of the other 12 issues that were rejected from an amendment perspective. So the first one I want to talk about is related to the previous one, is the one on premium receivables. I mentioned the PAA was particularly a particularly sensitive area of the application of the standard in terms of the presentation in the balance sheet, and that's because there is also a widespread acknowledgement that an existing accounting practice in the insurance sector, the one that recognizes premium receivable when they are billed to the client, the policyholder, will have to disappear. IFRS 17 requires all of the cash flows to be included before they are collected or paid in the fulfillment cash flows amount. And the fact that an invoicing process has taken place is not a valid justification to take anything out of the fulfillment cash flows amount into a separate asset, like a premium receivable balance. This is a major departure in terms of balance sheet presentation. Is linked back to the radical simplification I mentioned earlier. Some of the stakeholders even suggest that this would be better because a receivable could then be accounted for under IFRS 9 financial instruments, like other trade receivables in other industries. The staff concluded that this was not consistent with the amendments criteria that the IASB approved in October last year, and so proposed not to amend the requirements of IFRS 17 for this reason. They also noted that if you start measuring premium receivables and claims payable separately from insurance contracts, you would then create internal inconsistency in IFRS 17. Even if you restrict that to the premium allocation approach, you would then reduce comparability, and this would unduly disrupt implementation that are already underway. So with all these reasons taken together, the recommendation of no amendments is a key point that the IASB staff made. They also observed that if reporting entities with that particular problem were interested, nevertheless, to present the premium receivable in their financial statements, they could use the option available in paragraph 55 of IS1 that permits the presentation of subline items breaking down one of the mandatory line items that come from an IFRS requirement. In that particular instance is an IFRS 17 requirement in the balance sheet from 78, which could be broken down in subline items, one of which could be the premium receivable and the claims payables. And that could be still available for insurance companies to activate if they so wish to do. At the end of that exposition, the discussion was very brief, and the vote was unanimous in favor of the staff recommendation not to amend IFRS 17. The next topic that I want to talk about was the use of the locked-in discount rate to adjust the CSM. This is something that actually has been debated for a long time before and after the publication of IFRS 17. IFRS 17, as you know, requires the unwinding of the time value of money that has been calculated to determine the amount of CSM on initial recognition to be done by reference to the same discount rate that was used on that date, and that discount rate yield curve must not change in subsequent periods unless the CSM arises from an insurance contract that is accounted for under the variable fee approach. But in all other cases, the general measurement model mandates that the discount rate is the one on initial recognition, so it's locked in effectively. The difference between the current discount rate, which is mandated to be used for the fulfillment cash flows, the best estimate, and the CSM will have to flow through P&L or P&L and OCI, depending on the presentation accounting policy choice an insurance company will have made. Some of the stakeholders that are not interested in making that accounting policy choice would say that if we are accounting the full impact of time value of money through P&L, we should also be allowed to align the CSM accretion rate and discount rate for unlocking to the same discounting yield curve set of rates. And that would make their accounting more meaningful, in the opinion of these stakeholders, than by keeping the locked-in discount rates. The IASB staff, in their analysis, was not convinced and recommended not to amend IFRS 17. They also noted that using a locked-in discount rate is still a very valid approach for both the accretion and the calculation of the unlocking adjustments, because one, it is consistent with the rationale of unlocking the CSM based on the consistency between the unearned profit that is determined on initial recognition of a group of contracts and the effect of changes in the estimates of that profit. Two, because it ensures that the effects of changing discount rates on the difference in the estimated cash flows are not included in the CSM and therefore do not affect the insurance service result. This is also consistent with the principle in IFRS 17 that insurance service result is shown separately from the insurance finance income or expenses. And finally, this ensures that the revenue recognized as an entity provides the service from the insurance contractor is based on the price that was charged for that service when the contract was sold. Given that insurance contracts are always implicitly include in their price the timing advantage that the insurance company benefits from the fact that cash flows come in, the inflows come in first and the outflows go out later, that is a timing advantage. That is based on the price set on day one, which obviously in some way, shape or form takes into account the level of interest rates the insurance companies will observe at the market at the point of selling the contract. That is reflecting the price, but then if you are updating the discount rate, the IASB staff has been arguing, you then change effectively the pricing, but you're not really repricing the contract. You are now feeding a pricing element into the accounting without having actually the chance to change the pricing up or down for your customer. And so for that reason, they felt that that is something that must be reflected in financial statements, but not to reflect in the service result that comes from premium and claims, effectively. And so because of all these reasons, this is why the staff recommended not to amend IFRS 17 in this particular area. Some of the board members noted that although it is true that this has been voiced for several months, if not years, they are now of the view that this is not a widespread issue. And because of all the reasons stated in the staff agenda paper and their conclusion that emerged through the debate, they agreed unanimously, again, to not amend IFRS 17 for this particular concern. The next topic is about discount rates and risk adjustment, and how these two key elements of the insurance accounting model are done in practice. Particularly the fact that they are going to be calculated against a set of principle-based set of requirements, which allow insurance companies to execute against those principles, choosing from a fairly broad range of possible techniques. The concern here comes from the investors. They are concerned that this is too wide of an approach, and that could limit the comparability between insurance entities. So the alternative would be then to make the setting of the discount rates and the calculation of the risk adjustments a far more prescriptive matter in IFRS 17 by eliminating some of the principle-based and introducing a bit more of a rule-based approach on how to determine those two elements of the measurement model. The staff noted in the paper that this was a deliberate design of the IASB in keeping a principle-based approach to this material variable of the measurement model, and they have mitigated the issue around comparability by introducing some extensive disclosure requirements that would allow insurers to produce the information that users can then consume and understand how company X and company Y compare with each other or not. So the recommendation is not to amend 17, and some of the members of the IASB noted that also this one doesn't appear to be a widespread concern within the investor community. Given the arguments and given this empirical assessment of how widely the investors would demand this particular change, they again unanimously voted in favor of the recommendation of the IASB staff not to amend 17. The next one links back to the risk adjustment point earlier, but this one is more, if you like, more significant, given that it has been only recently flashed out. The instance was the May 2018 TRG meeting, when it emerged that I was in one camp and the other TRG members were in another camp, and effectively you could see that the TRG was not producing an indication of a consensus around the words that IFRS 17 has got in relation to the accounting for the diversification benefits. One camp felt that the reporting entity should be considered as the reference point for the measurement of the risk adjustment. And so when you are a group reporting entity and you're preparing a set of consolidated financial statements, you could have a greater diversification benefits than you would have as you aggregate the perspective of individual subsidiaries. Another camp viewed the fact that the words could be read actually to indicate that it is the issuing entity, the only perspective that should be taken in measuring the risk adjustment, and therefore the aggregation of the risk adjustments of the subsidiaries, subject to elimination of intercompany transaction, will be identical to the same measure of the risk adjustment at the consolidated level. The IASB staff and board members during the TRG discussion indicated that their intention was the latter view of the standard. And if you go back to the paper in October, you would have seen that there was an indication at that point to potentially amend IFRS 17 purely to clarify the intention of the IASB. The staff eventually actually changed their mind, and although they acknowledge that the initial view of an amendment to clarify could have produced the benefit of clarity, of course, in terms of how you do the measurement of a risk adjustment, and B, the fact that you could potentially make the comparability a little bit better. There is an issue around making this change at this point because it would indicate that this could be the only issue around risk adjustment, and that actually is not the right message. There are other matters that could be clarified at the same time, and so then people will wonder why they're clarifying these and not others. And as a result of that assessment, they propose not to amend IFRS 17 and to effectively leave it as it is, with, if you like, the doctrine that is emerging from discussion, including this board meeting in December, to be effectively the basis for us to know what to do. Board members understood the logic of the IASB staff and also highlighted that the risk adjustment measurement is inherently diverse, and that was done on purpose when they even abandoned the initial idea of recommending 3 techniques. That is gone since the 2013 exposure draft. The disclosures are going to be there to deal with the comparability, in particular the mandatory requirement to disclose the quantile that would actually be associated with the quantum of the risk adjustment if you were going to calculate that using the confidence interval technique. The benefit of consistency in this case do not appear to the IASB members to outweigh the significant disruption that they would put everyone under if they were going to amend the standard. And so with that said, 13 board members out against 1 voted in favor of the staff recommendation not to amend IFRS 17 to clarify this point. The next concern that the IASB debated is around the OCI option for insurance financed income or expenses. This is another example where we have a concern that comes from the presence of options in IFRS 17. So investors in particular appear to be of the view that options are not necessarily a welcome feature of an accounting standard, generally speaking, and so they suggested that perhaps the IASB should consider the merit of having introduced the option for OCI presentation of the time value of money, and remove it altogether and make everybody do the same, either P&L approach or everyone to do the OCI option. This could be improving the comparability from a user perspective and make the analysis of financial statements under IFRS 17 easier. The staff reflected on that concern and concluded that it shouldn't be accepted, and it doesn't pass the criteria because it goes against the principles that the IASB adopted throughout the standard setting phase when they were debating extensively whether to change the initial view of a mandatory OCI approach to one which made it eventually optional. That is the reflection of the economic substance that there are different business models in terms of asset liability management that deserve a different presentation in the financial statements. And it is only by allowing the insurer to make that as a policy choice that you can accommodate the need to reflect the different business models. And so the IASB staff recommendation not to amend IFRS 17 was again voted in favor by 13 board members against 1. The chairman also made an observation which I feel is valuable to share with you, and that said there is information for those investors that want to see everything through P&L to reconstruct in their analysis a full P&L approach to the time value of money, because the OCI disclosures are very clear. And he also said that if the market is really demanding a particular direction on that particular matter in terms of where should the discount rate effect go in the statement of comprehensive income, that will come out as a result of market forces and not as a result of a standard setting preliminary decision to make it so. So there is a laissez-faire approach here that is emerging in terms of how the IASB wants to deal with that, and investors will have to work through a world of insurance under IFRS 17 with both OCI option being elected and not. And that will then offer them the opportunity to push companies in one direction or another. But IFRS 17 will not change in this area. The next one is the insurance contracts with direct participating features and the definition in IFRS 17 that creates this subset of insurance contracts. Obviously, IFRS 17 goes a long way forward compared to IFRS 4, where we were merely looking at the definition of insurance contracts as a primary driver for the accounting that we have today. Going forward with 17, we will have to look at more important definitions inside the universe of insurance contracts, and the VFA clearly is perhaps the most material one. Some stakeholders are concerned that this current definition could be unnecessarily limiting the application of the variable fee approach to contracts which are economically similar to those contracts that currently meet the definition. And these group of contracts that is economically similar to the existing VFA contracts would actually be better off accounted under the VFA than under the general measurement model. The concern is particularly focused on two instances where there is this, if you like, vicinity between VFA and non-VFA contracts. The first one is you have contracts where there is already a relationship between investments and the insurance contract from a constructive rather than contractual obligation, but the VFA definition only talks about only contractual obligations or obligations that come from laws and regulations. The other one is the absence of a clearly identified pool of underlying items, while in substance there is a pool of underlying items used to fund the benefits payable under the contract. These concerns do not appear to be sufficiently strong to pass the criteria that the IASB approved last year for an amendment, and so the staff recommended not to amend the IFRS 17 definition. And in fact, they observed that contractual obligations and making those contractual obligations to state that there is a relationship between investments and insurance contract is actually a fundamental substantive aspect of the VFA definition, and that is why it is being picked to be a key component of the definition. That is what creates the variable fee. The other point is that also the identification of the pool of underlying items is actually inherently necessary to allow the accounting of the variable fee with the fully unlocked CSM accounting procedure that the VFA demands for those contracts. So given that, the definition is actually based on some substantive differences which the IASB staff concluded should not be disregarded because of the proximity with other similar contracts where these two areas are so fundamentally different. They are fundamentally different, and therefore they must not be accounted for under VFA. So this would be the basis that VFA should be done in IFRS 17, and if you are amending it, in addition to these points, you would also add further complexity to IFRS 17. As a result of all these arguments, the recommendation is not to change IFRS 17 definition for VFA. Several board members during the discussion noted that having a variable fee model invariably creates a point where you have a crossover, and that is inherent in whenever within a universe of transactions in a particular IFRS, you have within that same IFRS two variants of the same measurement model, and that is the case in IFRS 17. And so the fact that there is a crossover is just the way it is. Given all that, you would not be surprised to hear that even in this particular instance, the vote was unanimous in favor of not amending IFRS 17. The next one is on the limited applicability of the risk mitigation exception, another VFA-related topic. You probably remember that IFRS 17 introduces a new form of, let's call it, and allow me this liberal use of the words, hedge accounting. It happens when an insurance company enters into a derivative contract that is designed to effectively mitigate the negative impact that may arise from financial variables from variable fee approach contracts that the insurance has issued. The accounting that IFRS 17 will then allow you to do is to take some of the unlocking adjustments out of the CSM and to book them instead into P&L, against which you have the fair value gains and losses of the derivative. Think about the effect of interest rate guarantees in participating contracts as an example. When you look at these requirements, you may want to consider whether there are additional circumstances that would allow the recognition of the effect of these changes in P&L. For example, whether this hedge accounting should be limited to derivatives only, or whether there should be a more extensive range of hedging instruments to be considered, like, for example, reinsurance. Another point is on transition. IFRS 17 makes it very clear that this hedge accounting can be adopted, but only from a prospective point of view. Any hedging programs that pre-existed the date of initial application of IFRS 17 cannot be reflected under this accounting treatment, and will have to be accounted for in the usual way with adjustments to the opening equity of the entity. Stakeholder concerns are that both of these are too narrow approaches for the risk mitigation that happens in practice, and they would like to have non-transitional requirements to be broadened and transitional requirements to be allowing a retrospective application. In both instances, the IASB staff concluded that there is no ground for these concerns to be meeting all of the requirements, all the criteria agreed in October. The existing risk mitigation exception is intentionally designed to reduce accounting mismatches. So although there are amendments that permit this standard to be applied retrospectively for all the other requirements, the risk mitigation was deliberately excluded for that retrospective application because that would cause significant loss of useful information by creating a further inconsistency with IFRS 9. It also could enable the cherry picking of favorable outcomes in some entities while others were not elected because the outcomes will be negative. And that could create a complexity by making insurance entities less comparable with each other. So the board should not amend the non-transitional requirements of IFRS 17, also because there is a linkage with the prohibition to a retrospective application of the risk mitigation option. On the non-transitional requirements, another point that was made by a number of board members is that there is no new information as far as they're concerned to make them change their mind on this particular point. And so when they were called for a vote on the non-transitional requirements, they were unanimous to agree with the staff that there should be no recommendation. Interestingly, on the transitional requirements and whether, for example, there should be a retrospective application, or more interestingly, an application of the definition of the hedging instruments that goes beyond derivatives, they did not reach a conclusion. They just put it on hold and agree that reinsurance may be instruments that could be entered into by an insurer to achieve the same effect as they would by entering into a derivative. And so this one will be deferred to a future meeting, potentially this month, if not next month, if I'm right to guess that there will be 2 more rounds before this process is completed. And also they will have to be discussed in the context of the transition requirements that relate to the OCI option. So these will come back, and it was not decided one way or another in the December meeting. But from my personal perspective, I feel that it's only the perimeter of hedging instruments that could be potentially leading to some amendments in the next round of discussion. I doubt it sincerely that the IASB would actually reopen the decision to make this accounting treatment applicable only on a prospective basis. I really doubt it, based on the discussion that I observed in December. The next point is on business combinations. There are 2 points. So this is the first one of 2. You remember that IFRS 17 amended IFRS 3 so that the assessment of whether a contract acquired in a business combination is an insurance contract is paid based on the terms and conditions at the acquisition date, rather than at the inception of the contract as previously required with IFRS 3, if you like, under the IFRS 4 regime. In June 2018, the board also decided to amend IFRS 3 so that this is only applicable to business combinations that will occur when or after IFRS 17 is effective and not before. So there is a clear dividing line in the timetable as to when this will take place. This requirement clearly is something that will add some complexity and cost, and it could result in a different accounting treatment, also in terms of different reporting levels in a group. And because of these concerns, some of the stakeholders suggested that maybe reintroducing the exception that we had before IFRS 17 decision to do it differently would be better for users. The IASB staff is not of the view that this actually is an amendment that can pass the criteria the IASB agreed to use to assess each of the concerns, and so recommended not to amend IFRS 17 and IFRS 10, to keep it as it is, based on the 17 text plus the decision reached in June last year. The board members noted that one of the objectives of 17 is to bring accounting for insurance contracts more in line with the other standards. And so for that reason alone, if you like, it's important to remove that exception from IFRS 3 and to just rationalize it as agreed in June to be linked to the date in which IFRS 17 comes in the world of applied IFRSs. And so for that reason, this was another unanimous decision to reject the concern as a basis for an amendment and to agree with the staff that 17 should stay as it is, plus the voted amendment from the June board meeting. The other business combination concern is the one that comes from IFRS 17 application to contracts acquired while they are in the settlement period. A number of stakeholders observed that when you do that, IFRS 17 will require to calculate the fulfillment cash flows, compare them to fair value, and the difference to be recognized as a CSM. So suddenly, a liability for incurred claims, because it's been acquired, will produce insurance revenue. That means that if you are a company that uses a premium allocation approach extensively, but you happen to buy another company with the same type of business, that business may have liability for incurred claims. It's quite easy that to be the case. In the vendor company, the subsidiary you are acquiring, the liability for incurred claims will have no CSM. But the moment you buy it in the group financial statements of the buyer, you will start having to report CSM and develop a CSM system and data accordingly. So that is costly and onerous. The other point is that there could be a misleading effect on investors because in theory, well, in practice, actually, the coverage of these contracts is expired already. So what you're doing now is just settling incurred claims. There is no longer a standard rate obligation, and so the vendor is not booking revenue anymore. But there you go. You have a business combination, and so the acquirer now starts booking revenue because the staff argued there is now a new standard rate obligation comes from the business combination accounting, and you're now effectively paying a fair value as part of the consideration for buying the business that creates a CSM and therefore makes you deliver a service. Now, that would indicate new revenue comes out from contracts that in the vendor financial statements don't generate revenue. And so stakeholders are saying, is that really helpful to users? The staff thought about all these issues, but concluded that there is no sufficient ground here to make any changes, in particular because the stakeholders are suggesting some real measurement changes. And so they recommended that no amendments should be introduced. These would cause significant loss of useful information, would increase complexity, and also reduce comparability. Several board members agreed with the staff recommendation, also because they made reference to the IFRS 3 principles. And while there was some board members with sympathy for the impact that this will have on entities that are primarily using the premium allocation approach, the vast majority were in disagreement that at this stage there is time for them to debate and approve an expedient. So at this stage, they felt that the staff stands not to amend IFRS 17 should be approved. And as you can see, only one sympathetic member disagreed with the IASB staff. The other 13 agreed not to amend IFRS 17. And so that's another concern that will not feature in the exposure draft to come in the next few months. The next topic is the one on reinsurance, reinsurance contracts held. This is one of a few issues, but it's the only one that was debated in the IASB first round. So this is about the treatment of expected cash flows arising from underlying insurance contracts that have not yet been issued by the cedent. We know from the discussion within the TRG that the boundary is the boundary, and even if the cash flow arises from a yet to be sold insurance contracts that will be covered by the insurance contracts, the cedent must make an effort to estimate those cash flows. It's a fundamental aspect of measuring an insurance contract, and the same is true for the insurance contracts held. Every cash flow that is within the boundary must be included in the measurement. The contract boundary is also determined on the basis of substantive rights and obligations, and that principle appears to be solid, although if we count the number of contract boundary discussion we had in TRG, perhaps one can scratch his head a little bit about that. Anyway, stakeholders have three concerns about this entire set of requirements. The first one is that there is operational complexity in making a cedent estimate its own new business. The second one is that there is a potential mismatch between the insurance contract liability, which is not there, and the fact that the insurance contract asset will be effectively already accounted for, taking into account future contracts. And the last one is that because of that, you will then have also inconsistent recognition of the CSM on the insurance contracts held compared to the CSM from the underlying insurance contract issued. And so a modification of paragraph 34, contract boundary, and the modification of the principle on recognition of insurance contracts held under paragraph 62A could be considered. The staff concluded that there is no ground for that, and therefore no amendment will be recommended to the IASB. Further arguments that were articulated in the presentation the staff gave during the session is that the uncertainty of cash flows is not unique to reinsurance contracts held. It's just a different degree of uncertainty, and so that in itself doesn't make this case a special one. In order to apply the principles of the standard correctly, you will have to include those underlying future underlying insurance contracts in the cash flows. That is also in order to comply with the principles of having fully reflected the rights and obligations of the cedent in its financial statements. It's also true that when you are calculating this at initial recognition, they will come up with a nil amount because the fulfillment cash flows will be offset by the CSM. That is not necessarily true in the subsequent measurement period because of the changes in the discounting. The CSM is unlocked using the locked-in discount rate, and the fulfillment cash flows using the current discount rate. But this effect, which will produce inevitably a net asset or a net liability, depending on the difference between the two discount rates yield curves, didn't appear to merit a particular justification to open up further the issue for a potential amendment. The staff noted that modifying the contract boundary is also another no-go because there are three negative impacts. First, significant loss of use of information. Second, it doesn't fully reflect the entity's substantive rights to receive services from the insurer. And thirdly, it goes against the fundamental principle in IFRS 17 that all future cash flows within the boundary are reflected in the measurement. So because of all that, no amendment is recommended, and once again, unanimous support was given to the recommendation of the staff not to change IFRS 17. We come then to the last of the 13 concerns that were debated in December. This is on the specific requirements that IFRS 17 introduces for interim financial statements, as defined under IAS 34. The requirement is in paragraph P137, and that requirement mandates that if you are producing interim financial statements, you effectively have to take into account your assumptions at that reporting date, also when you prepare the annual financial statements. And there is no rollover of the annual set of assumptions covering also the interim period already reported. So that means that if you have an interim reporting date, you will then have those assumptions effectively locked down to represent the first 6 months or first 3 months of an interim period, and then you will have to do it again in the subsequent period. That means that if you could see the second half or the next 3 quarters, you can actually add up the quarters, or you can add up the 2 halves and get exactly the annual amount without exception. That's not necessarily the case under the other IFRSs where IAS 34 applies the rollover approach. And this is something that could create some practical issues, because if you think about subsidiary versus group, group is probably the one that is subject to interim reporting, but subsidiary may not be subject to interim reporting. So you may have differences, practical differences in terms of the application of 17 between subsidiary and group reporting. That could be, of course, expensive and may create confusion if the published financial statements of the subsidiary are then compared with elements of subsidiary reporting that may be visible in the group financial statements. There is also the fact that if you have an entity that reports more frequently than annually, the CSM recalculation could become particularly burdensome because effectively you have to duplicate it in that particular instance. And so stakeholders have suggested either to extend B137 to other types of reports, so you can then use it also for non-IAS 34 financial statements produced on an interim period. Others have actually said the other way around, said actually let's dilute it, and rather than making an amendment, so rather than making a requirement, let's make it an option. So only people that want to do that can do it, but those who don't want to do it, they can use the general principle of rolling over the IAS 34 basis. The IASB staff was not convinced by any of these suggestions, and they recommend not to amend IFRS 17. They noted that amending this requirement would actually create some complexity for both preparers and users, and would reduce the comparability among the entities. They also observed that if applying the requirements of IFRS 17 was an option, the second group of stakeholder suggestions, those entities that may decide to use or not use the option, they would have to consider all these factors, and that could have different priorities in different entities. Is the reporting frequency compared to the reporting frequency of others a factor? Whether there is a burden or not from a practical perspective, or whether you need to look at all these set of factors together to decide. That creates clearly a dilution of comparability. And because of all that, the recommendation is not to amend IFRS 17. Very little discussion on this point, and again, another unanimous vote in favor of accepting the recommendation from the staff not to change IFRS 17. So that completes the rundown of the 13 concerns. So let's talk about the next steps. This month, we're going to have another round, I'm expecting, of discussions. The 10 issues, a portion of those will be tabled, and we'll see how many of those that carried the October preliminary favorable assessment of the IASB staff towards an amendment will be presented for discussion during the board meeting that will take place probably around the 22nd or 23rd of January. Whatever is not going to be completed in this month, and that's my personal prediction, will be probably carried forward to the February meeting, when I'm expecting the 25 concerns to be deliberated for sure. We'll see whether I'm right as we go through the January and the February meetings. One other step that is going to come is another TRG meeting. You know that the IASB announced the December TRG was going to be rescheduled, and the new date is the 4th of April, again in London. And for those of you who are interested in asking a TRG perspective on a particular concern, issues must be submitted by the 14th of February this year. Obviously, early submissions are encouraged as well to allow the staff to work out an early publication of agenda papers. One point I also wanted to add to the next steps, which is not IASB related strictly speaking, is the fact that EFRAG endorsement advice based on the outcomes of the EFRAG board before Christmas will be published only when the next only when the text of IFRS 17 is stable. And so we need to wait not only the decision-making process to be completed, but also the publication of the exposure draft, the comment period, and the discussion of the comment period to be completed to see really a new text of IFRS 17 to be published, and therefore giving the European Union the possibility to do their job on assessing the endorsement. However, EFRAG board also agreed that the EFRAG bodies, in particular the Insurance Accounting Working Group and the Technical Expert Group, will continue to proactively engage with the IASB on the possible amendments to IFRS 17. I just want to make an extra point here, which is that the amendment that was approved this past month is one of the 6 issues that EFRAG highlighted as material issues in their letter to EFRAG, to the IASB, on the 3rd of September last year. And there will be another 4 issues out of the 6 that received already a favorable preliminary comment from the IASB staff in the October paper to be debated in January and February. So we'll see how the productivity of the European Union bodies will play out in the coming weeks. That is the last of my points. I'll land the end of my presentation to you on the final page, where you can see my contact details and the ways to stay connected with Deloitte on the topic. And with that, I'd like to invite the recording to be stopped and open formally the Q&A.